All right, what is going on, guys? Welcome to today's class within the options compound. What we are looking at today, what we'll be studying today, is the power of 50. Now, most people, if not everyone that trades, knows the significance of Fibonacci retracements, Fibonacci extensions. Most people just use Fibonacci retracements and target that 0.618 to the 78% retracement, as I did myself on the 24-hour. Looking at Tesla, pulled up the Fib retracement, went from April lows to December highs, pulled that out, and we had a perfect retracement down to 78.6%, as with all other moves on Tesla. So this is definitely something good to use Fib retracement for. This is not what we will be discussing today, although the method that we will be using comes from Fib retracement. What we are looking at today, and a lot of people know it as equilibrium, some people know it as convergence, midpoint, midway. What we're going to call it is the power of 50. So what this is, and I'll show you how to get the power of 50 box on your screen first. You go into Fibonacci retracement on TradingView. You scroll all the way down to gone. You use gone box. You can highlight it. You can put a star next to it, and then click the favorite or star button in the bottom left of your TradingView screen, and it should give you a hotbar that has the gone box on it. Once you put the box on your screen, click the box, go to settings. In the settings, you have 0, 0.5, and 1 active. That is it, 0, 0.5, and 1. This is under style. You should have a check next to these 3. If you put on the other 4, it just turns into a Fib retracement. All we're looking for is the 0, 0.5, and 1. And you make it whatever color you want. I have it green, yellow, and white. And this is what it should look like. What we're looking at with this box is you go to really any time frame you want. Doesn't matter what time frame you're looking at. What I found is that 50% is the most powerful confluence for shorter term moves on Qs. Really any individual stock, Tesla, Nvidia, MSTR, whatever stock you're looking at, that is going to be the most significant short-term retracement, your short-term target that you're looking for. So we go and draw from the, let's do Wednesday, yesterday, March 26th. We go and draw from the top to the bottom of that candle. Draw it out a little bit so we can see what today's price action did. What this tells me, and this is what a lot of people refer to as convergence, equilibrium is another big one that is directly from T's concepts as well as some other ICT concepts. Previous day equilibrium, we're going to call it the power of 50. Now we have it marked out on the 24-hour time frame. We go down to the 15-minute time frame. What this tells me is that this 50% retracement is what we should be targeting today. Now, I didn't draw it to pre-market lows, as this is today's price action. As you can see with the wick on the 24-hour, you're just drawing it from the previous day's candle. Previous day wick low to high. I use the 24-hour time frame. The daily time frame loses 9 hours of data. That is why I use the 24-hour time frame. There is a full 4 hours after market close and 5 hours before market open, 5.5 actually. So you're losing 9.5 hours of data if you're using the daily time frame. That is why I use the 24-hour, and you can get that through just going down here. You can already have it as a 24-hour, or you can add custom interval at the top of your screen. What we're doing with this time frame is this is a point of confluence, a draw, a point of interest. This is something that I expect price action to proceed to, tap, and then continue in the direction that it was going. If it does not continue, this is going to be a significant level break. So you trade it as a significant level break. A better way to view this is inverting the chart. This is obviously inverted. This is not saying yesterday's price action was bullish. We're climbing, 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 straight in one direction. What we'd be looking for is a retracement back down to 487, or the 50%, the power of 50, to have a continuation to the upside. It works on any stock that you're going to go look at, individuals as well. So we went on Tesla, And you can do this over multiple days as well. You don't just have to do it on one daily candle, although the percent gain typically lines up at scales and it works quite well regardless. If we're looking at Monday's move on Tesla and we just do the low to high of Monday's candle, can you see where we bounced off of Wednesday and Thursday, today's price action? Wednesday we came down, we made a little wick up, came all the way down, wicked below, and then closed over the 50%. Same with today's price action. We opened, made a wick low, and then proceeded up. Got over Tuesday's highs just barely as a point of resistance. That's another lesson to discuss, but as of right now, we're just looking at the 50%. This is a pretty significant level, right? Both the Wednesday and Thursday candle are holding it. If we go down to a 15-minute time frame, what happened every time that we dipped below that level? We got bought right back up and then continued to a new high, and this is just for the past 2 days of trading. Tuesday did not touch it. The other two did. So sometimes you don't touch it on the first day that you're looking for it to hit. Sometimes it takes 1, 2, 3 trading days. In this case on Qs, obviously we haven't hit 487 yet, 488. We will be looking for that tomorrow, Friday. We'll be looking for that level to hit and then either reject and continue this movement to the downside, go and target 481, 482, or we'll look for this level to break and continue up to the upside at 491. For a break of the 50% convergence, what you're looking for is something like exactly like this. We swept below, came back up. This is a play that you could take a bounce off of and it would work in your favor, but this is looking rather weak. And it came down, wicked off that level again. Following candle tried to bounce, got sold off with a wick above the body, closed below. That is your entry for shorting to the full retracement, or 100% of the retracement. If you break the 50, you typically go to 100% or you go to 0%, which is at that top line. Looking at Qs today, if we come up and let me get my box real quick so I can draw an example of a candle. If we come up and have a candle come in, close like this, the next candle should open, wick below the 50, and then have a nice move up like that. We'll draw in an arrow as well so you can visualize the wick on that candle. So the wick on that candle would look something like that. Oops. Let me draw that again. The wick on that candle would look something like that, and then it would continue pushing to the upside. And then you have your retest, it bounces off the 50% again, and then you're looking for a 100% retracement, or in this case, because we targeted a 50% to the downside, you're looking for a 0% retracement or back up to those previous highs, equilibrium. The next part that we're looking at is going to be on a 24-hour time frame, simply looking at the 24-hour time frame and nothing else. So going back to this Tesla example, and we'll get the volume out of here as we don't really need to use that for now. Looking at the Tesla example, let's draw it from the Friday close to Tuesday high and say that we're targeting a longer term move for the week. Draw this out so we include those candles. Friday's close to Tuesday's high, or we can use Friday's open to Tuesday's high. I'm going to use Friday's close, Tuesday's high. Price action came, swept below on the 50%, and then retraced all the way back up to equal highs on Tuesday. Now we're looking weak on Tesla at the moment. In this instance, this is a point of confluence for you to go long or short via what else you have drawn on your chart. In this case, and this is going to be another lesson as well, we have a pretty significant trend line up on Tesla. Can you agree? We have a daily time frame, 24-hour time frame, 1 bounce, 2 bounce, 3, 4, 5, 6 broke to the downside, and now we are back over that level, retesting it to the downside. This 50% mark, we closed a little bit under it, didn't we? In that instance, that would be your stop loss. So if you were going long on Tesla, and you enter this position and you say, okay, I'm going to enter at 270. The 50% line that I have is 270.72. We swept below that level. You can hold it if you'd like and target a 0.618 or 78 retracement, but we're only looking at the power of 50. In this case, it would have just been a stop out and then push up. So it's not going to be 100% win rate. You're going to miss some plays like this, like we just missed on Qs. We took this just now, and we measured this on the 15-minute time frame. We went opening low to opening high, retraced back down. We took longs on the 11:30 candle. It wicked up a little bit. We were in the profit for maybe 5 minutes, closed under that level, so that was our stop loss, because if it closes under 0.5, is there a reason for you to be in the trade if you're trading it off of the 50% retracement? Probably not. And then what the next two candles do, wicked up, and wicked all the way back up to 21.55. In this case, we were looking for 20,200. Didn't get that full PT, but this was still a nice trade. However, we were stopped out of it. It was a little fake out, drop below the 50%. Not really much you can do about that. What we can do is we can go and back test previous 50% retracements, and we're going to do that on Qs on the 15-minute time frame. And you guys can use this on whatever time frame you want. You can use it on the 5-minute, you can use it on the 15, the hour, 4-hour, 24-hour time frame. It works as it is a percent basis move. It does not matter what the price action is doing. The percent is going to be the same on a 1-minute time frame as it's going to be on a 15, as it is on a 4-hour and 24-hour, even up to a weekly. So you can use this on whatever time frame you want. What I would stick away from doing is marking a 50% retracement of every single candle. That's not going to do much for you. So what we're going to look at now is we're going to review yesterday's price action. Where this method shines is not in reversals, it's not in continuations, it's in trends. So I scratch that, is in continuations. Trend lines are where this method shines. If you're looking to re-enter, okay, Qs had a terrible drop down yesterday. We were just in free fall for the entire day. If I want to enter on a position, I'm not going to chase that all the way to the downside. That's a foolish thing. It's probably how you're going to get stopped out in a lot of positions. If you're chasing your price action, you're going to get bad entries. Regardless if you're trading options or futures, you're going to get a bad entry if you're chasing that candle to the downside, chasing it to the upside. What you're looking for is you're drawing it on these big candles, because the big candles typically retrace 50%. In this case, it did not, but it still retraced about 40%, 38 to 40%. Ideally, you want 50% for your best entry. Sometimes you're not always going to get that, but the way that this teaches you to trade is it shows you, rather than chasing a position to one side or the other, you want to enter a long on the opposing colored candle, you want to enter a short on the opposing colored candle. If I want to go short on NQ and I'm looking for a 50% retracement, I don't want to buy it when it's at 100% of the candle, right? Because I'm essentially buying it when most people are probably securing their positions. They just capitalized on a $3 candle to the downside. In that case, it's about 140 points on Qs or NQ on futures. A lot of people just made a lot of profit on that candle. They're not going to buy more positions at the bottom of it, are they? They're probably looking to close their positions. If they're closing their positions, that means that there are buyers that are stepping in. That's what creates this green wick up to the upside. And then as it retraces, again, it didn't retrace quite to that 50. That's okay. We just don't take the entry on that. As it retraces, shorts start getting back in their positions. And that's what I'm trying to teach. You're looking for a retracement. You're looking for your candle to be the opposing color when you get in either long, short, or if you're getting in a cash secured put or a covered call, you want that to be the opposing color of the direction that you're intending to trade. What that's going to do is it's going to cause it to be cheaper for you to get in. You're going to have more potential for your trade to play out, and your stop loss is going to be lower as well. If I enter this position at the bottom of this 15-minute candle, at the 100% mark of this candle, with no retracement whatsoever, my stop loss, let's say I have my stop loss at 492. That's a huge stop loss. And the next candle wicks up all the way to 490. I'm probably going to be down $500 on one NQ, $50 on one MNQ, depending on what you trade. I'm going to be down 500 before my trade's even able to develop. Whereas if I waited for the retracement, I'm going to get a much better entry. I'm going to get a much better deal on that position. Not going to have to worry too much about a wide stop loss. So if you're entering on trend lines down, and let's say we're expecting the market to continue to trend down, we mark it from the high or the open, the true open of yesterday's price action, and then let's mark it to the low of yesterday's price action during market hours, that is, and then connect it out so we can see how price action today fares. In this case, we didn't quite get up to 50 again, did we? But we were well on the way. We just went up a little too much too fast, and then we retraced back to the downside. That's okay. What this is showing you is that it's not going to hit every time. It's going to be a lot of waiting in the position. It's going to be a lot of waiting to get into the position. But in waiting, you're being patient with your trades. You're not rushing into them. Yes, you could have taken shorts and continued to pay on your position, but then you don't have any confluence, any validation for you to get into the position. You're just guessing, hey, upside, downside. That's not what you want to do. Now what we're going to do is go and review previous day's price action and how this position fared. Again, what we're looking at is the actual trading hours. To get this, I will go to symbol. Let's make the other after hours and pre-market a little bit different so you guys can see what I'm talking about. Let's review yesterday's price action. So this is Tuesday, March 25th that we're reviewing on the 15-minute time frame. We'll go ahead and replay once we have established our 50%, the power of 50. What I'm going to be looking at is the opening 15-minute range, as this is a trading strategy in itself. So you mark out the opening 15-minute low, the opening 15-minute high, and once you break out of that channel, that is your entry for longs or puts. You're looking for a retest, in which we retested perfectly with a wick down to 491.88 and then ended up running all the way up to 493. Using the power of 50, we're going to mark the the low of that 15-minute open to the high of this candle, and then we're going to draw it out to the right. I think I have that right there, and then right there. There we go. So opening 15-minute low, opening 15-minute, not 15-minute high, the high of the day, 11 o'clock. If I want to go long on the position, where would my best entry be? 50%. I mark the 15-minute opening high, 15-minute opening low. That is a trading strategy in itself. Do you see where the 12:15 and the 12:30 15-minute candles bounced? So we came all the way back down, even the 11:45 candle. We came all the way back down, tapped that level, had an initial bounce, and then had two candles that lined up with the 50% retracement as well as the 15-minute opening range. So you have two trading strategies that have a decent success rate that are pointing towards one direction. This is a double point for you to enter a point of confluence, 2 points of confluence for you to enter to the upside. In this case, you entered at, let's say, 492. That's when it hit your 50% retracement, 492.07. Your stop loss, you can put it at 75% just in case the candles wick down too fast for you to get out of your position. What happened to price action after that? We hit that yellow line, had a beautiful continuation to the upside, and then ended up making lower highs. That gets rid of that trend to the upside. Following candle, dollar candle down, we would already be out of the position here. And you don't need to hold your position to a full 100%. This is just showing that you can enter at 50%, and you're probably going to have a pretty high success rate of getting profitable positions out of that. You don't need to hold it for the big home run hits, but these are, I don't know, 3 about 20-cent candles in a row, and then with this wick, this is a dollar candle to the upside. About 80 points on NQ, and then obviously get slashed in the following candle. Even if we wanted to, let's say we wanted to play shorts, or we wanted to inverse this 115 candle. We draw the high to the low, draw it out to the right. Once we broke it, we almost went all the way back up to those equal highs. So this is again showing the 1 o'clock candle with the prior price action example. We didn't quite take those equal highs. We made a lower high, resuming downtrend, and then market on close data kind of skewed it. You wouldn't be trading the last 30 minutes regardless. So that was two successful trades that you could have taken on the 50% there. Draw it from wick low to wick high, and then your entry is when you retest that 50%, that yellow line right in the middle. We'll be going and viewing the following day, the previous day. Let's say I wanted to take longs again today. Draw it from the wick low to the wick high of the day. Continuation up to the upside. I don't want to enter when price action is sitting all the way up here. I'm not really going to get much of an entry, am I? If I entered at the full 100%, my stop loss, let's say it's at 50%, I want to see a continuation up. You're just going to be stopped out of this position. Pretty rough there for you. We didn't quite hit 50%, but can you see how close we were to it? So this one was 6 cents off, 6 cents off of hitting 50% retracement, and then we continued to the upside. I prefer to enter my positions once the 50% is hit. If you wanted to, though, you could put scale positions. So you could put one MNQ here at 49 and then another MNQ just below. In case you want to catch the kind of wick below that 50% and then continuation to the upside, that's up to you. I'm waiting for that 50%. Sometimes you're going to have trades like this where it almost hits it, you miss your entry, and then it continues to the upside. The way that we use this the best on the 24-hour time frame is using the previous day equilibrium. Now what this is going to do for you is you're going to go to the 24-hour time frame and you're going to mark the low and the high, and then you're going to draw it out. In this case, we opened over the 50% mark on Tuesday. What that gives you is a bullish bias for the following day. On Tuesday, we mark out the opening range high and low. We opened just over the 50%, so you would still have a bullish bias, but your stop loss is a close under 50%. Remember, so now you go down to the 15-minute time frame. We're going back to Wednesday's price action. Your bullish bias played out relatively well at open. You wicked off of 50% and then continued all the way back up and went back to 493. And what we'll do is we'll replay this and we'll go down to the 1 minute time frame so you can see exactly what happened. Opening wicked right to 50%, this yellow line. Can everyone see that? Wicked right to 50%, and then you had to move from 491.67 all the way up to 493. So your bullish bias held for this day. You had a perfect retracement of 50%, the previous day's equilibrium. And then you had about 120 point move on NQ. Options even, if you're trading this 491.60 all the way up to 493.30. Pretty solid move. That's going to net you just over 1 delta, probably about 20 to 30% on the position. And then what ended up happening, go back down to the 15-minute time frame. What ended up happening, once we continued on the 15-minute time frame and broke the convergence, the 50% from the previous day, your bullish bias for the day should be gone, and you're targeting a full retracement of the previous day. In this case, that's exactly what we did. Went right to that 100% retracement of the previous day, and then bounced all the way back up to 490. So that could be another entry for you to go long, and then your stop loss will be just below 488.87 or the 100% retracement. If the candle closes under that level, you're out of the position. In this case, we wicked to it, popped all the way up. Let's look at the following candle. Following candle closed below, so your bullish bias is completely gone for the day. Going back to the 24-hour time frame. Now we mark out yesterday's previous lows and highs to get that equilibrium. So get out of replay mode. Mark this out. Draw it out to the right. Move it down a little bit. So based on what we just covered, If we are open below previous day's equilibrium, the 50% mark, go down to a 15-minute time frame. What we're looking for is price action to hold the full retracement level. We opened just over it, wicked under, and then came back up and pushed almost to the 50%. If today's price action closes over 481.74, we should have a bullish bias for the following day. If it closes under, that is going to be a bearish bias for the following day. That is how you use your power of 50 to get bias for each trading day. In this case, we're most likely going to close today under the 0.5. So Friday's price action, especially if we close under Wednesday's low, Friday's price action is most likely going to be bearish. And you can do this, you can back test this as many days as you want. Let's go pick out Wednesday, March 19th, draw it up to the upside, continue it to the right. We opened above, so you still have a bullish bias, came back down, closed below the 50%, so you have a bearish bias heading into the following day. In this case, I know the daily candles and the 24-hour make it kind of iffy, but if you're replaying it real time, so if I go back to this candle and I'll go down to the 15-minute time frame, can you see where price action opened? So even if you had that bearish bias real time, it's still playing out the right way. Draw this over again. So you go into this day with a bearish bias, and then you can enter at a full retracement of the previous day's candle, in which case, in this case, we had 474, sorry. Your close below that is marking bearish bias for the day. We didn't close below that though, did we? We wicked twice off of it, indicating that you're probably going to draw up to that convergence or the power of 50, 479.67, and then we replay the candles from here. What did price action end up doing? Nice and slow. We'll click it a little bit faster here. All the way back up to the 0.5. And then once we hit the 0.5, we had a nice sweep back under it. And then heading into the following day, do we close over it? Yes, we do. We closed over the convergence. That gives you a bullish bias for the following day. Now let's continue this. And there you go. That is your bullish bias hit. You have a move from 481 all the way up to 487 on Qs. Pretty solid. And that's about how I use the Gone box. It's not too complicated. You're really just using it when you want to get into plays, and you use it to assess the bias that you have for the following trading day. As of right now on Qs, I need to invert this chart back. Don't worry, that wasn't a big green candle to the upside. If I want to enter long today, we're drawing it from the low to high again, drawing it to the right. Pretty messy day today, right? You don't really have any nice lines that go right to the 50% convergence. Power of 50, you don't have anything that looks pretty. It's kind of a messy chart, messy looking chart. No clear taps of it. Does this mean that you go and force a trade for the day? You go and force longs, you go and force shorts? Probably not. All this means, if the chart's looking this messy and your trading strategy is not working out as it has in previous days, then all you do, go ahead and click this X button at the top left, and you're going to leave that screen. There's no need to force trades when your trading strategy is not working. If the 50% convergence is not working for that day, guess what? There's another trading day tomorrow. And we'll cover another example here. So get rid of that replay. Let's use this Monday, March 10th candle. We're going to measure the high and low. So high to low. And we're going to draw it way out to the right here. Okay. Now, if I was just trading this based on these two candles, what is my entry going to do? If I enter on this 24-hour time frame, I see Okay, I drew the 50% from Monday's low to Monday's high. Because it was a red candle, I draw it from the top to the bottom. 50% is right at 479.25. I'm watching the Wednesday candle, watching. Okay, we wick over, close below 0.5. What does that mean for the following trading day? What bias would you have for the following trading day? And you guys can answer this in chat right now. So if I draw the top to bottom of that candle, I have my power of 50 set. We close just below after wicking over the 0.5. What is my bias for the following day? Bearish, right? Now we go to the following day's price action. Get that candle in there. There we go. We close below. That means I am bearish into the following day. What ended up happening with that candle? We went and swept all the way below the full retracement. So the 1.0, we swept below that level and closed over. Now that we did that, swept below on both that candle and the Tuesday candle, based off what I covered just before this. If we close over the full retracement, what can I expect for the following day? A bullish bias to the upside. And that is what we got, and we went right back to the 0.5. So I can get rid of this line here now, and let's just focus on the Thursday, March 13th candle with the following move on Friday, March 14th, sorry. Let's draw the wick high to wick low. So what we covered earlier in the video, if we open over the 50 convergence, equilibrium, power of 50, if we open over that level, what do you expect price action to do today? What is your bias for that day? Opened over the 50, swept below it, closed over it, and continued to the upside. You have a bullish bias for this daily candle. Now we go in, we mark the next day's equilibrium, opening high to opening low. Draw out to cover the following day. Let's see how that candle fared. Opened over. I wish I could, hold on, let's freeze that. Okay. So if this candle opens over, which it does, can you see how it freezes there a little bit? Hold on. Opened over, we have a bullish bias for that day as we opened over the 0.5. What did price action do for the day? Pretty solid move to the upside. Go in for this day, draw it again. Wick low to wick high. Falling price action. We opened over. Couldn't quite get up to that full retracement. Now we go down to the 15-minute time frame. Okay, let's see what happened. Pre-market. Oops, didn't mean to do that. Let me get back to that candle. Okay, we were on that one right there. So opened over, you have a bullish bias for the day. Go down to a 15-minute time frame, see where you would have been stopped out. You would have been stopped out of your position at 6 a.m. in the morning. So 6 a.m. is where your stop out was. We opened at that candle at 4 a.m., had an initial pop up, closed below, and then your bullish bias for the day is gone before the day's even started. Market opens at 9:30. You lost your bias at 6 a.m., and then you're looking for the full retracement down to 0, in which case we went all the way down. And then what happened to price action when we came up and retested it? Wicked off that level and then proceeded to close lower on the day. So you guys seeing how all these levels, there's only 3 levels that we're looking at, the 0, the 0.5, and the 1. You guys see how all these levels line up pretty well with each other? You guys can drop this in chat. Either drop it in the lounge chat or you can drop it in option chat, whichever one you want. You should be able to see that all these levels line up almost perfectly when they do work. And again, going back to today's price action, let's exit this replay mode. If we're using it on today's price action and we're saying, it looks pretty messy, right? There's not really a lot of clean breaks. We're not tapping the 0.5 and holding it. We're not tapping the 0 and holding it. We're not tapping the 1 and holding it. This is just a day that you close the charts. You do not need to force trades on this day. It's kind of a double-edged sword with this trading strategy, is that it works, and it works really well when the charts line up with the price action you're expecting. However, if you have a messy chart like today, it also works for telling you not to get into a trade. Hey, the 0.5 is not working. The power 50 is not working today. I'm just going to go ahead and close my charts. There's always going to be another trading day following unless the market ceases to exist, which I don't think is going to happen in our lifetime, but it might. Who knows? We have another one to review here. This one was actually, I think I included this on my Instagram page. Wick low to wick high. Opening low to opening high. Drew it out to the right. Was this a winning trade or a losing trade based on where the 0.5 closed? A losing trade. Doesn't work all the time. That's okay. Move out to the following time frame. This one was the pretty looking one. This one looked very good. So it works for both upside and downside. Wick low to wick high. Draw it out to the right. This one almost looks too perfect. It looks like it's made up. What happened once we broke the convergence to the downside? Power of 50. Convergence, equilibrium, 50% retracement. All the same thing. What happened when we broke it to the downside? 480 broke, came up and retested it. This is your entry to go short or play a continuation of the move to the downside. Following candle, $2 drop. And then you continue it all the way down to about 78% retracement of that entire move. You can get that with the fib retracement. Draw it from the bottom to the top. Move it over. This one actually exceeded 78%. This went all the way down to about, looks like 85-ish. And get rid of that. So pretty good looking move, huh? Almost looks too good to be true with the way that these levels line up. And this is what I mean by when it works, it works. When it doesn't, just close the charts for the day. Now we're going to draw it from the 4 a.m. open to the London lows. That's another point that I'd like to mention as well. I completely forgot to say that earlier in the video. This strategy works best measuring it from low to high of the session that you're trading. So if you're trading New York, you're measuring the low from 9:30. If you make a high at 11, there's your high. If you make a high at 12, there's your high. Make a high all the way at 2 o'clock, there's your high for the 50% retracement. Same for London. London is 4 right about until New York open. So you're measuring London low to London high. That's your 50. Asia session, you're measuring low to high from about 8 o'clock until the London session opens. So we go and use our gone box again. Let's get this on here. So I'm measuring it from the wick low to the wick high. Draw it out to the right. What happened once price action closed over the convergence, equilibrium, power of 50? What happened once price action closed over? Continued up all the way to the 0% retracement, or the full retracement of that model. Got to close just above it, and then ended up retracing all the way back down. In this case, because you fulfilled that retracement, delete it, and then you draw your next retracement. In this case, it is New York low to New York high. Draw it out to the right so you can include all these candles. Slash down, retested, continued lower. Looks pretty good. You can go to the previous day again. Let's say I wanted to take longs after the opening candle. I'm going to draw my convergence in there. Draw it out to the right. There you go. So in this case, this one's a little funky. You closed under, so you wouldn't have ended up taking that trade. If anything, you took shorts and you get stopped out on the following candle. What happened once price action came and retested that 50%? Came and hit it again, worked the second time, and then continued all the way up to 485. This one you could have an exception for. It was an FOMC day, maybe not trading that, so you could scrap that, even not trade the day as a whole, but it still worked for the second go around. And then the following day, we already covered that one. Did we cover this one? Let's see. So wick high to wick low to the open. In this case, we closed under, came up, retested, almost hit the 50, and then continued to the bottom. We hit the full retracement of this model. So once that hits, you go ahead and delete. Is this making sense to everyone? Everyone following along? It works best on the 15-minute time frame is what I found. So if I'm using this on the wick high to wick low for New York, draw it out. This one, we never retested anything up or down, so you wouldn't have taken any trades on Friday. March 11th, let's see this one. Draw it from wick low to wick high. This is a little difficult to do looking back at it, because real time, you're obviously not going to have these candles already printed if you're looking at 9:45 or 10 o'clock. So it's a little difficult, but okay, there we go. There we go. In this case, we draw it from the wick low, or the wick high open, all the way to New York low, New York high to New York low. Bounced. Where did we reject? If you're looking to play a continuation of the move, where did we reject? Reject right at the power of 50. Convergence, equilibrium. You enter shorts. Stop loss is a 15-minute close over the 0.5. Wicked over it, never closed over it, and then you had a nice drop almost all the way back down to those equal lows. So this one was a 471 to 466 drop. Probably about 220 points on NQ, about 50% gain on options. Goes to the previous day again. Let's draw it from New York low to New York high. Draw it out to the right. And we'll only use this one right here. Once we closed over, what happened? Came down, retested the 0.5, continued up to equal highs, and then kind of pittered out for the rest of the day. Another level that works really well with this trading strategy, if you want to use it for stop losses, continuation, reversal models even, true open on the day is a very good level to have a draw to. And all that means is that it's a level that you might kind of get a magnet draw. You might get sucked to that level. True open in this case was 479.11. So we draw a line there, draw it out to the right. Price action struggled to proceed over that level, proved to be a resistance, and then we get a nasty little rejection off that. So true open and the 50%, they work very well together, almost hand in hand. Very good. That will be it for the lesson today, though. I think we covered enough examples to show you guys how it works. You guys should be able to go back and watch the video as many times as you want. If you have any questions, tag me in chat. But that will be it for today's lesson. This will be posted directly after this live is ended. Have a good day, everyone. Peace out.